I want to tell you something most traders do not want to admit. You are not afraid of the market. You are afraid of what the market does to your mind when your real money is exposed. There is a difference. When you watch the chart with no position, you feel intelligent. You see the movement clearly. You can speak calmly. You can say, this is support. This is resistance. This is the trend. This is where I would enter. This is where I would cut. Everything feels simple when there is no consequence. But the moment you enter, the chart changes. Not physically. The candles are the same. The market is the same. The structure is the same. The price action is the same. But you are not the same. Suddenly, the same candle that looked normal becomes threatening. The same pullback that looked healthy becomes suspicious. The same stop loss you accepted 5 minutes ago now feels too painful. The same setup you trusted before entry now feels fragile. That is where the real lesson begins. Not on the chart. Inside you. I learned this early, sitting alone in front of screens in Japan. There was no cheering. No audience. No motivational speech. Just numbers moving, prices changing, and my own mind trying to survive the pressure. People like to talk about my profits. They like to talk about famous trades, large numbers, and moments where everything seemed effortless from the outside. But the money is never the full story. The real story is what happens before the money. The waiting. The restraint. The pressure. The strange loneliness of sitting there with your own decision, knowing nobody is coming to save you if you are wrong. When real money is in a trade, you meet a version of yourself that no backtest can show you. Backtesting shows you the strategy. Live trading shows you the trader. And sometimes, the trader is the problem. This is why so many people are confused. They think they need another setup. Another indicator. Another confirmation. Another mentor. Another funded account. Another chart layout. But they never ask the real question. Can I stay the same person after I enter the trade? That question matters more than most strategies. Because if you become emotional the moment money is involved, then your strategy is not really being tested. Your nervous system is being tested. And if your nervous system is untrained, it will override everything you know. You can know the correct stop and still move it. You can know the correct entry and still chase. You can know the correct target and still exit early. You can know your daily loss limit and still break it. That means the issue is not information. The issue is execution under emotional pressure. And execution under pressure is the real skill. Most traders do not train this. They train the chart. They do not train the body. They train entries. They do not train discomfort. They train patterns. They do not train the moment their hands become tense and their breathing changes. So when the live trade starts moving against them, they do not execute their plan. They execute their fear. That is why they lose. Not always because the setup was bad. Because the setup never had a fair chance. The trader interfered. The trader panicked. The trader wanted relief. You must understand this clearly. When you close a good trade too early, many times it is not because the market changed. It is because your discomfort became louder than your plan. When you hold a bad trade too long, many times it is not because there was real hope. It is because accepting the loss felt like accepting failure. When you revenge trade after a loss, it is not because a new opportunity appeared. It is because your ego wanted to repair itself. The market did not force these actions. You did. This is why I say real money does not create your weakness. It reveals it. If you are impatient, real money reveals it. If you are greedy, real money reveals it. If you are desperate, real money reveals it. If you secretly need the trade to validate you, real money reveals it. If your risk is too large for your mind, real money reveals it immediately. You may hide these things in study. You may hide them in theory. You may hide them when talking to other traders. But you cannot hide them inside a live position. The market will pull them out of you. One tick at a time. That is why live trading feels so different. It is not because the market becomes harder. It is because you become less honest. Before entry, you say, I accept the risk. After entry, you say, maybe I should give it more room. Before entry, you say, I will wait for confirmation. After entry, you say, I cannot miss this. Before entry, you say, I am calm. After entry, your body says, get me out. This conflict is the source of panic. Panic is not random. Panic appears when your plan and your emotions disagree. And most traders create this conflict before the trade even begins. They enter with too much size. They enter without a clear invalidation. They enter because they are bored. They enter because they want to recover. They enter because they do not want to miss the move. Then they act surprised when they feel unstable. But instability was built into the trade from the beginning. A trade entered from emotional pressure will usually be managed with emotional pressure. Do not expect calm management from a chaotic entry. That is fantasy. A calm trade starts before you click. It starts with the reason for the trade. It starts with the risk. It starts with the acceptance of loss. It starts with knowing exactly what would make you wrong. Not emotionally wrong. Technically wrong. There is a difference. A candle moving against you does not automatically make you wrong. A pullback does not automatically make you wrong. A temporary red P&L does not automatically make you wrong. You are wrong when the reason for the trade is gone. Most traders do not understand this. They confuse discomfort with invalidation. The trade moves against them a little, and they think, something is wrong. Maybe nothing is wrong. Maybe the trade is breathing. Maybe your size is too large. Maybe your expectations are childish. Maybe you thought the market would enter your position and immediately reward you. That is not trading. That is emotional entitlement. The market owes you nothing after entry. It does not owe you instant profit. It does not owe you clean movement. It does not owe you comfort. It does not owe you a straight line. Your job is not to demand comfort. Your job is to manage uncertainty. That is what trading is. A professional does not enter because he knows what will happen. He enters because he knows what he will do depending on what happens. That is the difference. The amateur wants certainty from the market. The professional creates certainty in his own behavior. That is why calm traders look different. They are not calm because they know the future. They are calm because they have already accepted multiple futures. If the trade works, they know what to do. If the trade fails, they know what to do. If the trade goes sideways, they know what to do. If volatility expands, they know what to do. If the setup disappears, they know what to do. There is no argument inside them. That is calmness. Not confidence. Not arrogance. Not positive thinking. Calmness is the absence of internal negotiation. When I entered a trade, I did not want to be debating with myself after the fact. Debate inside a live trade is dangerous. It means your plan was incomplete or your risk was not accepted. The market moves too fast for emotional debate. You need decisions prepared before pressure arrives. This is why I always respected preparation more than prediction. Prediction is cheap. Anyone can predict. Anyone can say, I think this goes up. The market is full of opinions. But preparation is different. Preparation says, if I am wrong, this is where I live. Preparation says, if I am right, this is how I hold. Preparation says, if nothing is clear, I do nothing. Preparation says, if I feel emotional, I stop. That is real professionalism. Not being right all the time. Being structured when you are uncertain. Many traders think they panic because they lack confidence. No. Often they panic because they have too much fake confidence before entry. They convince themselves the trade is perfect. They imagine the win. They imagine the payout. They imagine the recovery. They imagine how good it will feel when the trade works. Then the trade pulls back, and their fantasy breaks. That break feels like fear. But the problem was not fear. The problem was expectation. You expected the trade to behave. You expected the market to confirm you. You expected real money to feel like backtesting. That expectation was weak. The market exposed it. A strong trader does not need the trade to work. He only needs himself to work. That is the standard. Did I execute? Did I follow risk? Did I wait for my setup? Did I avoid emotional action? Did I take the stop when the stop came? Did I leave the trade alone when there was nothing to change? That is what matters. The money follows later. But if you chase money first, you usually lose behavior. And when behavior breaks, everything breaks. Let me tell you something about size. Size is the fastest way to expose a liar. A trader can say he is calm with small money. That means very little. Increase the risk, and you will see the truth. I do not say this because size is bad. Size is necessary eventually. But size must be earned. Most traders want large profits before they have built emotional capacity. That is backwards. You do not increase size to become confident. You become consistent first, then size becomes possible. If your body panics when you enter, your size is probably too large. If you cannot stop watching every tick, your size is probably too large. If a normal pullback makes you want to interfere, your size is probably too large. If a loss would make you revenge trade, your size is too large. This is not complicated. The correct size is not only a mathematical number. It is also a psychological number. A position can be technically small and still emotionally too big for the trader. That is why copying someone else's risk model is dangerous. You do not have their account. You do not have their experience. You do not have their nervous system. You do not have their emotional tolerance. You must find a size where you can think clearly. Clear thinking is more important than impressive risk. A small size traded with discipline is better than a large size traded like a frightened animal. Many traders hate this because their ego wants faster results. They say, but small size will not change my life. Correct. But emotional size may destroy your account before your life ever changes. You are trying to skip the stage where you become stable. The market does not forgive that. Stability first. Size second. Profit third. Most traders reverse the order. Profit first. Size first. Stability later. That is why they stay trapped. They are trying to extract money from a mind that cannot handle pressure. This is like building a tall building on weak ground. It may stand for a while. Then one day, under stress, it collapses. A trader collapses the same way. Not because of one trade. Because the foundation was weak. Every unaccepted loss. Every emotional entry. Every move stop. Every revenge trade. Every oversized position. Every broken promise. These things weaken the foundation. Then one bad day arrives and everyone says, I blew up because of that day. No. That day only revealed the structure was already damaged. This is why calmness must become a daily practice. You do not build calmness by reading about it once. You build it through repetition. You build it by taking the stop when you want to move it. You build it by waiting when you want to chase. You build it by closing the platform when your rules say stop. You build it by letting a winner breathe when your fear wants quick relief. You build it by reducing size when your ego wants to prove something. You build it by doing the correct thing while your emotions argue. That is training. Not motivational words. Training. Every trade is training you. The only question is, what is it training you to become? If you keep moving stops, you are training yourself to disrespect risk. If you keep closing early from fear, you are training yourself not to trust your plan. If you keep revenge trading, you are training yourself to use the market for emotional repair. If you keep oversizing, you are training your body to associate trading with panic. But if you follow rules, even when uncomfortable, you train something else. You train steadiness. You train patience. You train trust. You train the identity of a professional. And over time, this identity becomes stronger than the impulse. That is when trading changes. Not because the market changes. Because you stop changing every time the market moves. That is a powerful place to reach. The market can pull back, and you remain clear. The trade can go red, and you remain objective. The winner can grow, and you do not become greedy. The loss can happen, and you do not become desperate. That is not natural. That is built. Humans are not naturally good traders. Humans want certainty. Markets offer probability. Humans want control. Markets offer movement. Humans want immediate relief. Trading requires delayed judgment. Humans want to be right. Trading requires accepting being wrong often. So do not insult yourself because trading feels difficult. It should feel difficult. You are training against natural instinct. But do not use that as an excuse. Difficult does not mean impossible. It means you must approach it correctly. The correct approach is not to force calmness. You cannot force calmness in the middle of chaos. You must design conditions where calmness can survive. That means clear rules. Acceptable risk. Limited trades. Defined session times. No emotional entries. No random adjustments. No trading when tired. No trading when angry. No trading to recover. No trading to feel better. If you break these rules, do not act shocked when you panic. You invited panic into the room. A trader must become very honest about his state. Before I trade, am I calm? Am I focused? Am I trying to make back money? Am I angry? Am I bored? Am I desperate? Am I trading because the setup is there, or because I need something from the market? This question is brutal. Because many times, the honest answer is ugly. You are not trading opportunity. You are trading need. Need is dangerous. The market punishes need. The more you need the trade to work, the less clearly you will manage it. The less you need the trade to work, the more professionally you can execute. This is one of the paradoxes of trading. The trader who needs money badly usually trades poorly. The trader who can accept missing the trade, losing the trade, or waiting longer usually trades better. Because he is free. Freedom in trading is not having unlimited capital. Freedom is not being emotionally owned by the outcome. That is real freedom. When you can take a loss and remain yourself, you are free. When you can miss a move and remain yourself, you are free. When you can have a green day and stop, you are free. When you can have a red day and stop, you are free. Until then, the market owns parts of you. Your mood. Your confidence. Your discipline. Your identity. And whatever the market owns, it can shake. This is why detachment matters. Not coldness. Not carelessness. Detachment. You still care about execution. You still care about risk. You still care about improvement. But you do not attach your self-worth to one outcome. A trade is not a verdict on your life. It is a single event inside a long series. Professionals understand series. Amateurs obsess over individual outcomes. The amateur says, this trade has to work. The professional says, this trade is one of many. That mindset alone reduces pressure. Because if a trade is one of many, it does not need to carry your entire emotional world. It can simply be executed. Win or lose. Data. Process. Review. Next. This is how calmness compounds. You stop worshipping each trade. You start respecting the process. But process must be real. Not something you say after a loss to feel better. Real process means written rules. Real process means reviewing mistakes. Real process means cutting behavior that damages you. Real process means accepting that your feelings are not instructions. Many traders say, I follow my process, but they do not have one. They have preferences. They have ideas. They have things they try to do when they feel strong. That is not a process. A process must survive emotion. A process must tell you what to do when you are not at your best. That is the entire point. You do not need rules for calm days. You need rules for dangerous days. The day after a big loss. The day after a big win. The day you feel behind. The day you see everyone else making money. The day price runs without you. The day your first trade loses. Those are the days where your process matters. Because those are the days where the emotional trader appears. And if you have no structure, he takes control. I want to talk about watching the trade. Many traders destroy themselves by staring too much. They think watching more means managing better. Not always. Sometimes watching more means feeling more. And feeling more leads to interfering more. If your trade is planned on a 5-minute chart, why are you reacting to every tick? If your invalidation is below structure, why are you panicking over a small wick? If your target is clear, why are you changing it because of one candle? This is not management. This is anxiety with a chart open. There are times to monitor closely. But there are also times to step back. You must know the difference. If your system requires patience, then you must create space for patience. You cannot say, I want to let winners run, while staring at every fluctuation like your life depends on it. You will not let anything run that way. You will suffocate the trade. Good trades need room. And con traders give room because the risk was accepted before entry. That is the key. If you cannot give the trade room, either your plan is unclear or your risk is too large. Fix that. Do not blame the market. The market will always move. It will never move in a way designed to keep you comfortable. You must build comfort from structure, not from price behavior. Let me give you a simple rule. If you are surprised by your own emotions after entry, your preparation was incomplete. You should already know that fear may appear. You should already know that greed may appear. You should already know that doubt may appear. You should already know the exact situations that make you unstable. Then you prepare responses. Not fantasies. Responses. If I feel the urge to move my stop, I will stand up and read my written invalidation. If I want to close early, I will check whether the exit condition actually happened. If I lose 2 trades, I am done. If I feel revenge, platform closed. If I feel euphoric after a win, platform closed. This is how you protect yourself from yourself. That is not weakness. That is intelligence. A trader who knows his flaws and builds systems around them is far stronger than a trader who pretends he has no flaws. The market loves the second trader. He is easy to trap. He believes discipline will appear when needed. It will not. Discipline must already be there. You cannot build a fire escape after the building is burning. You cannot create calmness after panic has taken over. You must prepare before the pressure. This is why I respect routine. Not because routine is exciting. Because routine lowers emotional noise. Same preparation. Same risk check. Same session window. Same setup criteria. Same review. Same stop rules. Same shutdown rules. Repetition makes behavior less negotiable. And the less you negotiate with yourself, the calmer you become. Many traders lose because every trade becomes a fresh emotional debate. Should I enter? Should I hold? Should I exit? Should I add? Should I move the stop? Should I take profit? Should I trade again? Too many decisions. Too much freedom. Too much room for emotion. Professional trading reduces unnecessary decisions. Before the trade, decide as much as possible. During the trade, execute as much as possible. After the trade, review as honestly as possible. That is the structure. Not complicated, but difficult. Because your emotions will ask for exceptions. And exceptions are where traders bleed. One time becomes a habit. A habit becomes identity. Identity becomes account history. If you want different results, stop making exceptions for the emotional version of yourself. He has already proven he cannot be trusted. Give him rules. Give him limits. Give him consequences. This is how you become calm. Not by hoping. By removing choices from the part of you that makes bad choices. I want you to understand the role of humility here. Humility is not thinking you are bad. Humility is understanding that you are vulnerable. Even after success. Especially after success. A winning streak can be more dangerous than a losing streak. After losses, you may become cautious. After wins, you may become proud. Pride makes you loosen risk. Pride makes you believe you see everything. Pride makes you take trades outside the plan. Pride makes you think, I'm locked in today. Then the market changes character, and you are too slow to notice. The con trader respects the market even after winning. He does not worship himself because of a green day. He does not believe profit means he is untouchable. He knows that the same market that paid him today can punish him tomorrow if his behavior slips. This is why I say calmness requires humility. You must trust your preparation while respecting uncertainty. Both at the same time. Too little confidence and you hesitate. Too much confidence and you become careless. The balance is quiet. I have a plan, but I may be wrong. I can execute, but I do not control the outcome. I will take the trade, but I will not marry the idea. That is mature trading. Most traders are not mature. They fall in love with their analysis. They want the market to prove them right. They treat exits like defeat. But exiting when your plan says exit is not defeat. It is professionalism. A small control loss is not failure. It is maintenance. It keeps you in the game. The real failure is allowing one trade to damage your mind, your account, and your future decisions. This is why risk management is emotional management. People think risk management is just numbers. It is not. Risk management is how you keep your mind usable. If the risk is too large, your mind becomes distorted. You start seeing danger everywhere. You start interfering. You start hoping. You start bargaining. You start making decisions to avoid pain instead of decisions based on the chart. So risk is not only about protecting money. It protects perception. That is critical. A scared trader does not see clearly. A greedy trader does not see clearly. A desperate trader does not see clearly. If your risk creates fear, your analysis after entry becomes unreliable. This is why position sizing is not optional. It is the foundation of clear sight. You want to trade calmly. Trade at a size where you can watch the market objectively. If you cannot do that, reduce. Again and again until you can. Your ego will hate this. Good. Your ego is not the one who should manage risk. Your future self should. The trader you want to become does not need heroic size today. He needs clean reps. Clean execution. Clean losses. Clean wins. Clean stops. Clean reviews. This is how you build the internal evidence that you can trust yourself. Confidence should come from evidence. Not from hype. Not from one big win. Not from a backtest screenshot. Evidence. I followed my rules 20 trades in a row. I stopped after my max loss. I did not revenge trade. I held according to plan. I accepted risk. I reviewed honestly. This kind of evidence creates real confidence. And real confidence is calm. Fake confidence is loud before entry and terrified after entry. Real confidence is quiet before entry and steady after entry. That is what you want.